across the Illawarra, Shoalhaven and Southern Highlands. This is ABC Illawarra.
All right, so let's talk interest rates and the RBA's decision to raise them from 0.1 to 0.35. Been a lot spoken about this today. The Principal of Digital Finance Analytics based in Thirroul, Martin North, joins me now. Hello there, Martin. Oops, sorry, wait a second. I've got to press the right button. I've got control of a few levers here as well, and I'm using them incorrectly. Good to talk to you, Martin.
Hello.
So, speaking of levers, let's start simple. What is the RBA trying to achieve by increasing interest rates? It's presumably not to strike panic into the heart of mortgage holders.
No. Well, one of the critical things, the RBA has an inflation target of between 2 and 3%. And so what they're trying to do is to manage the levers which I have, which is essentially interest rates, to try and keep the inflation targeted in that range. Now, of course, it's way higher. It's 5.1% at the moment. That was the latest data that came out not long ago. And actually, non-discretionary spending, the stuff you've got to buy, is at 6.6%. So we've got an inflation problem. Not the only country to have it. Most other Western countries have got this same problem. So the question is, what should the Reserve Bank do to try and get itself back in its mandate? And the answer is, it's pretty much the only game in town: lift interest rates.
I mean, there was a suggestion because of the COVID pandemic and everything else that inflation was going to hit. Is this too late to reel in the inflation? Could it have been a less painful move if it happened a little earlier?
Well, my own perspective has been that they were taking the rates too low for too long. They should have been doing this last year. For example, in New Zealand, the Reserve Bank in New Zealand started lifting rates last year. Their cash rate's now 1.5%. Ours is at a much lower level now. Yeah, I think they were late to the party. But there's another question too. What's causing the inflation? Right? Is the inflation created by things that interest rate movements could impact? And that's a really interesting question, because a lot of the inflation is actually supply chain disruptions that are causing it. The war in Ukraine, oil prices, all those things. And there's a long bow between moving interest rates up and trying to actually deal with supply chain disruptions. I mean, essentially what you're trying to do is to tailor back demand so that effectively it comes back. But the other part of it is a lot of the inflation stuff was created by government policy here and ultra-low interest rates and the bank's quantitative easing programs. So we've got a problem where inflation is being driven by multiple different factors. Raising interest rates will address some of them, but not all of them.
So then how do you know? What are you looking for to see if the plan will work? What are you looking at?
Well, essentially what you have to do is to look to see what now happens. Will, in fact, the inflation read drop back? Now, of course, we have a problem because our inflation is only reported once every quarter. So it's always way behind real life, right? So we won't know for a little while. And so if we start seeing inflation come down a little, then we know we're in the right direction. And the RBA today signalled multiple interest rate rises are ahead to get us back into their 2 to 3% target range, but they did say that inflation is more likely to be higher ahead first. So, they're basically shaping our expectations. Inflation will go higher, they will keep rising rates, and they will lift rates until such time as inflation comes back down to the 2 to 3% band. The trouble is, it's a really blunt lever. And as I say, a lot of this inflation is supply chain related, so therefore it may not have the impact that they want.
I mean, as you mentioned, New Zealand, who did increase their interest rates, but they've actually got a 30-year high at the moment, don't they, of inflation?
Correct. Yes, and the US is even worse than Australia and the UK too. So in the UK they've lifted interest rates. In the US they've just started. They're going to probably lift later in the week. So this inflation thing is created by the central bank quantitative easing programs and ultra-low interest rates. You can actually trace it all the way back, by the way, to the global financial crisis more than a decade ago. So this is not just COVID-created. This is not recent policy. This is a fallout from many, many years of very, very cheap lending, ultra-low rates, quantitative easing programs. So this is a structural problem that's been created by central bank strategies around the world. And now the question, of course, is can they put the genie back in the bottle or not? And the answer is nobody knows.
Well, someone has sent in a text saying, Lindsay, the government sold off the Commonwealth Bank in 1996, thus deregulating the banking industry, which dictates mortgage interest rates. It's a no-brainer, but politicians won't admit it, nor the banks. What did the result? What was the result of the Commonwealth Bank being sold off in 1996? And has it something to do with this?
Right. It has a huge amount to do with it. This is about the deregulation of the financial system, right? If you go back a couple of decades, there were checks and balances on what the banks could do and how they could lend, and lending standards were much more conservative, maybe 3 times income if you were really lucky. That was all deregulated away, let the markets rip. Banks should be able to lend as much as they want. Consumers should be able to get into as much debt as they want. I mean, that is, if you like, a particular philosophy which has been driving economies around the world for the last 20 years. I think it's failing, by the way, because what we've got is huge amounts of debt. We've got households that are, up to their eyeballs in mortgages at very low rates. And a generation of people have never seen interest rates move up. So this is a new and difficult experience for many. But there are some structural questions here. Is the free markets that have been, reigning for so long actually doing the right thing for ordinary Australians? My own perspective is probably not.
Ordinary Australians is a very interesting term. Someone here said, and I believe this person may be an ordinary Australian, if you don't mind me saying so, whoever texted this, ask your intelligent person, I think that's you, Mr. North, why the cash rate goes up, say, 1%, yet banks hike it up 2%.
Now, here you've got to understand that banks make money at the difference between the rate they pay on deposits and what they charge for their loans, right? Now, they're looking for any excuse that they can to increase their margins because their margins have been crushed over recent times because of the ultra-low interest rates. So you can pretty much bet your bottom dollar that those movements from the cash rate will get directly passed on to variable rate mortgages. We've already seen fixed rate mortgages rise a lot higher. They may do a little bit on the deposit side to try and actually get some more deposit money because they need to fund their business. But ultimately, the banks are looking at their margins, and their margins are being squeezed, so they're going to try and hold back some of that variation thanks to the change in rates because they need to try and support their shareholders. And it's another interesting question, are banks there to provide loans to households at the best rate possible, or are the banks there to actually maximise their returns to their shareholders? And going back to this market economy again, it's about return to shareholders rather than actually the lowest possible cost to borrowers.
Speaking of Martin North from Digital Finance Analytics, I mean, you did mention, the 2 different things that a bank does do, and there is, other people besides borrowers who will be impacted. So there could be a benefit for people, with their savings and term deposits and that kind of thing.
Yeah, term deposit rates are already rising, not uniformly, and actually the big banks are very, very slow. Some of their term deposit rates are disgustingly low. But there are other lenders out there and other borrowers and other depositors who are actually doing a lot better on the deposit side. So, shop around if you've got money to put on term deposit, and if you want to log it in for 4 or 5 years, you can get 4 or 5%, which is a pretty good rate. I'd also make the other point though, people with mortgages. Again, a lot of people are with the big guys and paying a lot more than they need to because people don't shop around. So the message is shop around even in this environment. You can probably do better.
The comment does get made a lot, and someone's just sent us a text that, when in 1990, my first home rate was 17% under Hawke Keating. Now it's, so much less than that. Is there, when we're presumably not going to get back up to 17%, but where do you think, as this is actually a return to normal levels, where we may start to plateau?
Yeah, it's a great question, and the markets are saying rates will get to about 3.5% on the cash rate, so add another 3%, so mortgage rates of 6 or 7%. That would be the long-term average for mortgage rates over the last 50 years. My own view is that rates won't go that high because if they went that high, it would crush the economy. So I think the terminal rate, as they call it, for this series of rate rises is probably about 2%. Plus or minus, but that would still put mortgage rates up at 5 or 6%, which is a lot higher than it's been. And to go back to my earlier point, more people are borrowing much more than previously. So it used to be 2.5 to 3 times household income on the mortgage. Now it's 4, 5, 6, 7, 8, 9 times. In Sydney, a lot of people are 9 to 10 times, which is hugely leveraged. That's why the debts are so big. And, of course, that's why there's no wriggle room. Most households that have got these big mortgages, particularly those bought in the last couple of years, really have no wriggle room. And whilst they may have this buffer in theory, and everybody's the Reserve Bank and government saying, well, everyone's got huge buffers. No, everybody hasn't. Some people do. Some people have done really well. Some people have paid ahead. But a lot of households that I see in my surveys have no buffer. They're right on the edge even now with rates ultra low. And so we're going to see more mortgage stress and more difficulty in the months ahead. And, of course, people need to plan for more rate rises, not just one, but a series over the next few months.
Yeah, and as you mentioned, even though we're not up to the 17%, the actual price of a house these days is so many more years' wage than it was back in those days. All right, so, I guess we can just put our seatbelts on and see where we end up.
Well, just one last thought. Yeah. If rates go up by 2%, the average monthly repayment goes up by 30%. Right? It's a big leverage because of the very low interest rates that we've got. So whilst those rate rises may sound quite small, the actual cash out each month that people are going to have to find is going to start accelerating quite quickly, and that's where I think we're going to see trouble ahead. But again, you've got to plan, think about it, and make moves now to get your debts more under control and know where you're spending so that you can hunker down and live with that rising rates. That's the best way, I think.
What does it do for the stock market and the Aussie dollar and that kind of thing? What has been the reaction so far?
Well, the Aussie dollar went higher against the US dollar, and that might be weakness to the dollar, but I think it was more that now, of course, people are thinking that rates will be higher and therefore the exchange rate perhaps will be more supported. The bonds rate went higher again, so that's another forward signal of higher interest rates ahead. The stock market was a little bit weaker after the announcement, and my own read on the stock markets around the world is there's much more downside risk than upside risk or upside potential from where we are now. I expect stock markets in the next few months to continue to go lower and substantially lower. The reason is that with higher interest rates, a lot of stocks are now worth less than they were previously because of their future cash flows. And, of course, more people will be worried about the impact of a recession or a slowdown or less economic growth. The RBA is saying that growth will be 2% in a couple of years' time rather than 4% now. So everyone's now worrying about the downturn. If there's a downturn, if there's a recession, that leads to lower stock prices. So some investors who are in those markets may also see those assets also decreasing in value. House prices will probably also come back too. So we're going to move into this part of the cycle where effectively asset values are going to drop rather than grow.
All right, Martin North. Good to talk to you. We'll talk to you again soon, I reckon.
Cheers. Plenty to talk about.
Yes,
Cheers.
Exactly right. See you later. Martin North there, the Principal of Digital Finance Analytics.